Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. Yo, 1 o'clock on the East Coast, July the 17th. It is a Wednesday. Guy Adami, Dan Nathan, soon to be joined by the great Carter Worth.
Yeah, he's just stepping in for us.
By the way, if it's Wednesday,
it's Butters. You know, it's Butters. It's John Butters. He's the senior
you're
analyst.
I wasn't going to say it because Amanda gets mad at me.
She does get mad. But you know what? We got a lot going on.
We do.
Usually on most days you say, interesting day in the market.
No. I've been saying that for a while. I mean, I say it on days that don't appear to be interesting, that are interesting to me.
Yeah.
Today is a day that is obviously interesting.
Well, what we try to do is even on those days where it's a low vol day, the VIX is under 13, we'll try to come up with something. We'll try to demystify some stuff in the markets, guy. But let's just throw it up there.
Throw the rundown
let's
up.
Get up
Come
there.
on. I mean, check this out.
So it's interesting. So we were doing, our work in front of the market call, and all of a sudden we get an email from Worth Charting. That would be Carter Worth thing about the KRE. That is the regional banking index. We're already working on something there. So we said, you know what? Let's get Dubs in here. What else are we going to do, Guy?
Well, we're going to look at the fade, the bank bounces, you said. We're going to look at the chip wreck. And again, I think people are going to point the finger at some of the commentary that came out of a candidate, former President Trump interview with Bloomberg a few weeks ago that sort of came out yesterday in terms of some of the dynamics. And I think people are blaming that cause and effect. Maybe. I think that's a part of it, clearly. But there have been things that have been setting up towards this for a while. And if we have time, which we should, a little audience Q&A, as I mentioned, Butters.
Yeah. All right.
That's a lot.
Let's hit this, because normally we start out by saying, the S&P is up whatever percent. Today it's down 1.3%. The NASDAQ 100 is usually up, maybe 1% or so just for shits and giggles.
Oh!
And here it is, the NASDAQ 100 is down 2.75%. We've been quoting this stat that Liz Young started, I want to say 2 or 3 months ago, that the S&P hasn't had a down day in down 2% day. I think, Guy, it's above 400 days. I think you have to go.
It's close, but I mean, it doesn't matter. Your point is well taken. Whether it's 375 or 400, it's pretty epic in terms of the amount of time that we have not seen a 2% down day in the S&P. And I'm not suggesting we're going to get that today, but it's as close as we've been in a while.
Well, I'll tell you this. I mean, like, the bounces intraday so far,
anemic.
They've been anemic. All right. So the report that caught my eye, Guy, wasn't the report that Carter did on the KRE, but we're going to talk about that. It was really broadening out from the S&P 500, looking at some all-world indices. So let's bring him in, Carter Worth of Worth Chart. There he is. Look at him.
What's up, fellas? How are you? Big move in those banks.
Well, Carter, before we get to the banks, let's talk about this report. It's for your cork board, okay?
So, which I don't even know what that means.
You know what it is.
I know. I used to have a cork board behind
you. You pin something up there.
You could say FYI, that's one's overused, right? You could say for your eyes only. That would be something private. Leave that up to you, Guy. It could be a lot of things, but the corkboard's an old-fashioned thing that Guy and I grew up with. I'm about 3 years younger than he is. And there were corkboards and push pins. They're long gone with staplers and other things, but there used to be these things.
Well, let's take a look at it. I mean, might as well throw it up because this is your work. The MSCI All Country World Index 30-year monthly bar chart. That's going to be fascinating. The Russell 3000 30-year monthly bar chart, and the S&P 500 30-year monthly bar chart. So a lot of things to look at without question, and your work is fascinating on these three things, and I am taking notice. And the reason why we wanted to have you in at sort of an emergency basis, right, call in the big left-hander, is because of exactly this, Carter.
Let's do it. 3 charts. They're all the same time frame. Why don't we do 1, 2, 3, 1, 2, 3, and then we'll go and look at them each at one time. All right. So start at the top. The biggest one, of course, is the MSCI All Country World Index. Just to put it in context, that's 77 trillion. The S&P is about 52. And so, look, internal trend lines are not as important as trend lines, but what we know is, per chance, the peak in 2000 was a peak, a valuation peak, a market peak. We know that the peak in 2021, from which we just had the 22, 23 bear market, NASDAQ sold off 37, S&P 27, was a peak in valuation, and we're back to that internal trend line. Some people say the Buffett indicator, right? Market cap, GDP, or whatever it is also at an all-time high. Now, this is I put it as buyer beware, right? I mean, and so one could say, well, one could always be pessimistic and missing out, but I mean, it's always about, are you committing new capital? Are you reducing capital exposure to anything, right? You have a great athlete on your team and he's been good for 9 years. Do you give him another 9? Probably not. Do you give him a 2-year contract? Okay, let's talk about it. Meaning, here and now, are we committing more capital, a lot of capital? Are we reducing? Nothing. I just think buyer beware is the nuanced way to say, hey, trim, reduce, do something. So the next index is the Russell 3000. Of course, that's just to show you 61 trillion versus 70 plus. And we're also, interestingly, right back to an important juncture. And then finally, the S&P. And the S&P, and I made a point, it says slightly above, about 2% above. With today's move, maybe only 1. But the point is that this has to be. One could say, what do you want me to do? Make all my bets for the next week or for the next quarter based on this? No, that's why it says for your corkboard. I'd have it over your shoulder, but I'd look at it from time to time and be aware that this is where we are in the big map, right? So you can look at the here and now map on your GPS. You can also look at the 30,000-foot view. That's what this is.
All three line up the same way. I'm sure this is something you've been looking at for quite some time. I don't know if it's rare or not where they all sort of line up this way, but I've pointed out a number of times, and I'm curious as to your thoughts. The longer the duration of the lines, the more powerful and the more important they become. So, you're talking about something that goes back to the late 1990s. So almost by definition, you have to, again, you can say, you know what, Guy, Carter, Dan, it's going to blow through this line. That's fine. I mean, that's your choice, but you have to take it into consideration, right?
Well, it's just being aware of reference point. If you were out, do you have your flashlight on? Do you have your compass? Do you have your map? Do you have, proper water? Do you know which way it's all tools that one uses to find one's way, to try to divine the way forward, the best way forward, and to make decisions and judgments as one goes about the business of buying and selling risk assets. And so this has to be something that one, I think, should be aware of.
Yeah, it's pretty fascinating when you think about those market caps that you laid them out, and let's focus on the S&P 500 here at 52.6 trillion. We know that 3 stocks, that's Apple, Microsoft, and Nvidia, make up about $10 trillion. So you're nearing, a number that looks like, 20% or so. That's just 3 stocks. So again, when we talk about this super trend or mega trend and the mania that is focused around it, I mean, there's plenty of stocks out there that have benefited from this, but there's few stocks in the last 6 months who have benefited more than Apple, Nvidia, and Microsoft. So again, you better be all in on that strategy if you think that we're going to break out above this long 30-year trend that's been in place.
Right.
We spent some time yesterday on yields. We got your take on it. You think a pair of twos, maybe we get down, we'll just throw up the 10-year treasury yield back towards that lower bound of that downtrend. And what does that look like, Guy? 4.1%, maybe get down towards 4%. We're not going to spend any more time on that, but we want to kind of get to what I think is some really interesting price action. In the mega cap banks are just trading really well in and around this. So you're seeing money come out of tech and go into them. We've been talking about this all week, as many of them reported Friday, Monday, Tuesday. Look at that, the JP Morgan, it's on a runaway breakout. But this was one that caught my eye yesterday, Guy, and I know it caught yours. Schwab, they reported, they talked about kind of what is in their balance sheet. They're talking about basically about deposits. They were talking about net interest income being lower than expected. Talk to me when you see a 2-day move like that, Guy, a huge gap lower, closing on the low, a follow through that moving average, and then continues to go at the same pace it was going yesterday.
When things went pear-shaped last spring, a lot of people, myself included, I don't want to take myself out of the equation, thought that, Schwab might be the next sort of ground zero as to what could break. And that seemed to be the correct stance for a period of time until it was not. And then like the rest of these things, Schwab got back on its horse. But what I've been saying for a while, and I think it's sort of bearing out, their problems weren't cured. What was cured, sort of the market bailed them out. And Now the same things to a large extent that you were concerned about, I don't know, 15, 16 or so months ago, are seemingly rearing their head again. So I don't want to put too fine a point of it. I'm not here to suggest that Schwab is the broader market, but man, oh man, you're talking about a very important name just in terms of sentiment, in terms of what's going on. And when you see a move like that, seemingly out of nowhere, because that's juxtaposes, to your point, some of the other financials that have been doing extraordinarily well, you have to pay attention.
Well, the other point, and Carter, maybe you can opine on this a little bit, and I know you have some charts to talk about the KRE, but as it relates to Schwab, I mean, one of the reasons why we lost Silicon Valley Bank, well, we lost some of these other regional banks, was because the higher rates it made those losses on their mark-to-market, treasury holdings look that much worse. And so why would Schwab right now, as yields are, lower, as the Fed is about to cut interest rates, right? Why would this company that just said they're going to shrink the bank, okay, the biggest revenue stream is net interest income, so I get that, but why is it acting this way right now? And what does it mean for the rest of the regionals as we kind of hear from them? Maybe it is juxtaposed to what's going on in rates. So again, Carter, thoughts on the Schwab chart really quickly when you see this?
Yeah, I mean, exactly. I mean, look, we had Wells dropping Gap, and you got Schwab. The rest of them generally okay. Bank of America the best, and sort of around the horn like that. I think this is idiosyncratic, and obviously it's very much news related. And to be fair, they're not so much of a lending traditional SNL, if you will, savings and loan, or a regional bank as their own animal. But either way, bad price action that cannot be excused or ignored. And I would, if I were long, even here, I would take measures.
Whoa.
Now, and I want to, Schwab is one of those names, I think again, I'm not suggesting you trade it, but in terms of what it potentially could mean for just sort of the appetite for market risk and stuff, this is one you have to watch. And if you go back again, April, May, June of last year, I mean, there was a lot of concern around the broader market predicated on what was going on in Charles Schwab. So just something to keep in mind. Again, a lot of it has to do with some of the comments from the CFO.
Yeah, no doubt. Carter, walk us through the KRE, the Regional Bank Index. This has been on fire as the Russell 2000 has taken off. Obviously, we talked about that a little bit yesterday. You're seeing a commensurate move in the KRE, up about 20% in a week or so.
Yeah.
Yeah, I've seen. I mean, there's a lot of reports out about the 4 standard deviations never happened in any index ever in the history of market, all sorts of stuff. And look, there are many ways to measure overbought. Just to my eye, it's about the eye. It's not about anything else, because I don't use oscillators indicators. It's almost as straight up as the angle was on the straight down. The straight down, of course, was news related, Silicon Valley Bank and First Republic and so forth. And so we're in the process of retracing that drop and precipitous news-related fall. Now, this one is prospectively also news-related, something to do with the presidency, perhaps, or interest rates, or what have you. But we're back to a difficult level. So let's depict that. First, we have a 56% sell-off from the peak. That's the 20 market sells off in the period. Just to put in context, right? S&P drops 27 and NASDAQ 37. This thing drops 56 and then 65% back. Let's look at it another way. Kind of symmetrical. One's down for 16 months, one's up for 15 months. Put those two charts together. Okay, let's keep going. Another way to depict it. It's a 50% retracement. I don't use Fibonacci. No one needs Carter Worth. You can do that on any software program, but it has to be noted. It's retraced exactly half of its sell-off. And then final chart, if we just leave it with just the blue line, and this is what overhead supply is. Said in very plain language, there are many purchases made in the KRE itself or banks that related to it before the plunge of March of 2023. Many people, once presented with a loss, book it. All right, I'm out. 10% hit myself. Many never book it, and they say, I'll ride this, I'll end run this thing if I have to. I'll take it to zero. I don't want to be the person who bought poorly and then dumps it to low. If it rallies all the way back, I'll have 2 mistakes, and I'll probably climb the bridge and jump. And then there's that third crowd. We're back to a difficult level, which is to say, I've got my money back. Let me get out of this thing and move on.
And I'll never do it again.
I never do it again. My first boss told me don't catch the falling knife, and oh my God, all these things. And so self-recrimination, right? Self-loathing, on and on. But either way, it is what it is. It's nothing other than a rally, and an impressive one, to a difficult level where overhead supply comes into play. Now, we did a strangle on it. That's our take. You sell to the people who are even bullish here. We sold calls to them, and then sold puts, which means it gets put to us at 50. Hey, that's not so bad. But that's an open-ended technique that most won't do. But I'd love to hear what trade you have.
Yeah,
Dan.
and Dan does have a trade, and we have some charts as well. And we'll throw our first chart up, and I'll opine quickly in terms of. First of all, I want to say that I was one of the people that did not see this coming. I don't think. Well, there were people that saw it. I was not one of them. So I think a lot of it's been obviously predicated on the move into small caps. So there's been this catch-up trade going on. But the question I think you have to ask yourself, if you're going to continue to play this from the long side and continue to be bullish here, what's the catalyst now? Because if you think about what's going on, I mean, there's a slowdown in terms of some of the data we've seen, without question. Small and regional banks are sort of the epicenter of the economy, if you think about it. The unemployment rate seems to be ticking up. The retail sales number, which everybody sort of championed yesterday, Rosie actually pointed out yesterday that there was some seasonality fugaziness that actually masked what was a horrible retail sales number. So if small and regional banks, again, the lifeblood of what's going on, they're going to be, I think there's going to be a lot of headwinds for them going forward. I don't think any of that is abated. What's changed here, there's been a obviously move in rates. I think there's been some enthusiasm around the space. There's been a rotation out of big cap tech into small caps and into these banks. I just don't think it's going to last, because I think the headwinds are not only still there, but are probably getting stronger.
Yeah, and I would just say that, as let's just say if the market were to get worse, if we were to have that S&P down 2% day of the first time in, a very long time, I would expect the KRE to reverse. And so I would see correlations start to go up. We've been talking a lot about this rotation, but sooner or later, if there's real fear in the market, you will see a whole host of things sell off together. While we have this chart up, first of all, Carter, your charts were absolutely amazing. It tells a very obvious story, but you got to be able to think in different time frames and have the framework, I guess, also to do that. My eye's a little simpler here. You know what I mean? And so I look at this chart right here and I say to myself, the last time you see that move off the October lows to the December highs, that was a 45% move. Okay. And then when I think about just the move off that 200-day moving average, it was about 22.5% or so. Well, here we are in a week, up 20% off that 200-day. And I think that we're going to have a retracement here. So if I want to play it with options, you're obviously using short premium. Okay. I want to use long premium and make a directional trade here. So today, when the KRE was trading about 56.90, there's the trade there. I could buy the August 56.52 put spread, paying about $1 for that. Buying one of the August 56 puts for about $1.40, selling one of the August 52 puts at about 40 cents. That's my $1 in premium. This trade breaks even down at 55. I have gains up to 3 between 55 and 52 with a max gain of 3 below 52. Losses up to 1 between 55 and 56 with a max loss of $1 above 56. This trade risks less than 2% of the ETF price, has a break even down 3.3% and a max gain down about 8.5%. So again, I'm going to use a 50% premium stop here if the stock just continues to go higher or goes sideways and the premium, the dollar that I spent, starts to erode. I'm going to basically close this trade at 50 cents. And just lastly, I just think at some point a retracement makes some sense, and getting back towards that $52.50 breakout level makes some sense to me.
So I look at this. You probably have a month in terms of duration. I don't know when the expiry date is, but
it's August 16.
All right, so ish. I'm pretty close, right? So I also think, and I think you believe this as well, I think you're going to know within the next week and a half whether you're right or not. And I think it's going to sort of play out quicker than I think most market participants think. So you're giving yourself the right amount of time, I believe. And I like the strategy. This is one, I do believe it's overextended. I don't think it's moving for fundamental reasons. I think it's a little bit of momentum, a little bit of a catch-up trade here. But again, I'll say it for the third time, the headwinds that have been there for these small and regional banks have not abated. If anything, they've gotten a little stronger.
Yeah, last chart I just want to bring up here. This is implied volatility, the price of options versus realized volatility. If you look at that right there, they're right near each other. Now they picked up off of from fairly low levels. Generally, you would see, volatility, at least the implied, kind of move lower as a stock or an ETF grinds higher. But now that we're starting to pick up a little bit, we're in line with the historical vol. It makes directional trades, in my opinion, long premium, look that much more attractive. Carter, just really quickly before we let you out of here, we really appreciate you jumping in here. What do you think of that breakout level targeting 52 or so? We're 56.90 right now.
I mean, yeah, that's and that's kind of where we are. I mean, I like those levels. That makes a lot of sense to me. And it's what's so funny. It's time frames. It always is, right? So there are people who just now, because of this move, for standard deviations up 10, 15%, they're like, we can now make a structural 3-year bet, a judgment that small can outperform. We should increase our exposure here at our $700 billion mutual fund complex by 80 basis points to smaller banks versus big, all because of, whereas tactically someone said, wait, what? It just went up 12%. I'm selling the hell out of this thing. So it's all about, right, timeframes, ever thus.
I'm with you. I think it's an interesting trade for sure, and you're taking advantage of the strength. Doesn't matter what the strength is on the back of. The strength is there, and you look to take advantage of these things. Other people will say, you know what, guy, I think this is going to continue. That's fine. I mean, that's what makes markets, as they say. I am not one of those people. So Carter, thanks for sticking around. I think we're going to let Dubs go, right?
Yeah, thank you, Carter. Have a great weekend.
All right, buddy. Man. Talk soon. Of course.
He's the man.
He's the man.
So last night on Fast Money, you were not there, but.
Nope.
I would say midway through the show, we had breaking news that I guess former President Trump, candidate Trump, did an interview with Bloomberg a few weeks ago-ish, and some of the notes came out from the interview, and there were a few things. One of them was he was going to let Jerome Powell finish out his term, which I don't think is necessarily true, but that's what he said. Talked about Jamie Dimon potentially for Treasury Secretary. I don't think that's happening, but he said that as well. But then a couple things that really caught my eye. Number one, he said the Fed should not be cutting rates ahead of the election for political reasons, which, again, my point was the Fed is an independent organization. If the data suggests it should have nothing to do with the political cycle. But again, I get it. The other thing he said that really was the takeaway for me was about China and Taiwan and how, sort of a shrug of the shoulders type of thing with China and Taiwan. And, maybe we're not going to offend Taiwan. And again, people will point to the sell-off today. That was the catalyst. And obviously that is a big component of it, but there've been other things going on as well. But let's break this down.
Yeah, I guess, the other thing, it's just amazing that these two comments came out, one from Trump and one from Biden. They're kind of ratchet up the trade war a little bit. And that's one of the reasons why, you're seeing, those two, that's a double whammy right there. Right. And so you think about Taiwan Semi, and they're 85% of the high-end GPUs. That's what they are manufacturing here. And overnight, you had ASML. So it basically didn't guide up enough, Guy. And so that's interesting to me. That stock's down about 11%. Or so. And so tonight, overnight, we're going to have Taiwan Semi. Now, we've already had a preliminary read on earnings. We're going to get sales. We're going to get guidance. And some folks are saying, listen, if we don't beat or they don't beat by 5-10% or so, both guidance and the upside, and they don't guide CapEx to the high end, this could just add more fuel to this downside fire. Amanda just kind of flashed up the performance of some of these names. I mean, when you think about how the SMH has just been this kind of quiet stair step, man. It's been driven by, a few big names or so. What do you make of that price action, Guy, in one day?
Well, it's dramatic in a word, but it's not, I don't think it's that surprising. Again, it's interesting. What we've talked about in terms of valuation and stuff, we said valuation is not a timing mechanism. Yeah. However, the richer things get, the more you have to thread the needle, right? And the less room you have for error in terms of some of these things. And ASML is part of it without question. And, if you just don't give guidance or say something that the street was not anticipating, you're going to sort of suffer the consequences. And that's what happens when stocks get rich. When things are reasonable, you don't have these types of moves. So the move to me, actually, does make a little bit of sense. Now, in terms of Taiwan Semi specifically, I mean, this is the epicenter of everything. We've talked about it for a while. And the fact that, again, two candidates in differing ways can be so, and I'm going to choose this word carefully, cavalier in their stance is interesting because, as I've said a number of times, I mean, there is an existential risk out there to the market. One of them is the situation between China and Taiwan. And just go back a year or so ago, Jensen Huang, was one of the things that he said was his concern about NVIDIA was the potential for things to dust up between China and Taiwan. So just keep that out there too. And quickly, don't discount the technicals around this as well. And, I don't know how many times we talked about March 8th, after March 8th, and that subsequently proved to be correct in terms of the reversal. And we've pointed out June 20th in terms of the same type of price action that we saw in NVIDIA. And now that's starting to play out as well, Dan.
Yeah, there was an interesting article in the Information. It's a tech publication that I read, and they're very good, and they're covering AI probably better than anybody right now. But they had a story about, basically loopholes for Chinese companies to get access to basically high-end chips in the data centers that, let's say, Google and Microsoft have created. And so the story is talking about how basically they are renting servers equipped with those high-end GPUs to Chinese companies through data centers located outside of China. And, I have to think that that's something that regulators are going to start to pay attention to, both the Biden administration, but then let's just say hypothetically, you have Trump back in office. This is kind of an easy target because if you think about the current administration, the FTC, they've been all over Microsoft and Google and others, right? And you got to think based on how we know Trump, kind of coordinated or with the regulators about these same companies, this only gets ratcheted up. And so I think worst comes to worst, Google and Microsoft stop doing it. Okay. But what does that mean for demand for these high-end chips as NVIDIA is going to basically do this transition to Blackwell this next year?
We're going to find out. And, we're going to, obviously in terms of NVIDIA, we're not going to find out in terms of the quarter for a while, but I think you're going to start to, my sense is the commentary you heard out of Goldman Sachs a week or so ago, out of Sequoia a week or so ago, and Roger McNamee, those three, one individual, two groups, I think you're going to get more and more people start to at least explore the possibility of the back end of this trade maybe not being everything that people thought, on top of everything you just talked about, some of the political risks associated with it.
Well, it's funny. The Goldman commentary is being echoed by lots of different companies in different verticals, right? So they built out some of these capabilities, or they're renting some of these capabilities, and they built on top of, let's say, Microsoft Copilot or whatever. You're not hearing too many folks in the C-suite saying that they're getting, a great return right now. And that could be one of the reasons why you see a dampening of demand in the back half of this year.
We talked about, by the way, I mean, there's no back padding here, but we had that same conversation with Deirdre Bosa and you on OK Computer. We've tried to point out that we're not discounting the CapEx spend. I mean, that's there in front of everybody. What I've been concerned about is the monetization of it, right? And what is the end use, and what are these companies getting out of that type of spend? Because at a certain point, I mean, it's return on investment, right?
100%.
And there's been, at least till date, I haven't seen the real use case. Anyway, back to you.
All right, let's do it. John Butters, Senior Earnings Insight Analyst over there at FactSet. We get a little bit of a preview guy to the email, the report that goes out at the end of the week here. You know where you can get that. It's FactSet. Let's throw it up there. Let's throw the little slide up there. Oh, bang. Insight.factset.com/subscribe. You can have it delivered to your inbox Friday morning, but you also get a preview from us here. So Butters is working on some year-over-year earnings growth statistics. This is important as we get into the meat of Q2 earnings season. So here we are. Of the top 5 contributors to earnings growth, that's year-over-year for the S&P 500 Q2 2024, 4 are the Magnificent Seven companies. Overall, the blended earnings growth rate for the entire S&P 500 is 9.4% for Q2. NVIDIA, Amazon, Meta, Google are combined a projected earnings growth of 56.2% for Q2 2024. The blended earnings growth rate for the other 496 is 5.4%.
It's like an SAT question, right? I mean, and the answer is, whoa. Talk about a top-heavy market, not only in sort of stock performance, but in earnings performance as well, which is also something we've pointed out. This basically says to me what we've been saying all along. Below the surface, if you really start to examine, you don't have the commensurate growth to justify the valuations that the market is trading at right now. And people will say, well, these names will continue to sort of carry the water. Maybe,
Right.
maybe not. Because if you start to see, again, if you see even a hint of a slowdown, watch what happens to the broader market. It won't have anything to do with, again, necessarily the earnings growth. But if you start to see a tick down in expectations, the market will sell first and ask questions later, which has concerned me for a while. And that concern has been unjustified, but that's something you have to take into consideration.
Right. And if you go back to what we just were talking about a minute ago, I mean, when you think of that 56% expected earnings growth of those four names, if there's just a decel, if there's Q3 guidance that comes in below the whisper, right, then you have a situation where all that multiple expansion that you've seen in those biggest names because of this mega trend, because of that growth that is just outpacing every other industry within the S&P 500, that's when you start to rethink some of that. So again, I'm going to keep a close eye on Microsoft, on Amazon, on Google, and on Meta, because they make up 40% of NVIDIA's revenues. And if you were to see them guide CapEx a bit lower or revenue growth a bit lower, that's when you have some problems there in that kind of unequal expectation of growth. And the last thing I'll just say, and you've mentioned this, guy, is that a lot of this has been, this price appreciation has been on multiple expansions. So when you have 4 or 5 names growing that fast, you say, you know what, I normally pay 31 times for those stocks. I'm willing to pay 35, 36, 37. So again, we'll just leave it at that.
Well, I mean, it's what we say all the time. No, valuation doesn't matter until it does. And you're like, that's a dumb thing to say. Well, not really, because when it does matter, that's when it matters in a meaningful way. And then, right now, until today, at least, nobody's cared at all about valuation. My sense is if you get a continuation of, you're going to hear more and more people start to chirp about all the different valuation metrics that we've been pointing out for quite some time.
Right. And this is why the guidance for Q3 or the back half of this year is going to be really important. So on this slide, I think it's fascinating. By Q4 2024, analysts expect double-digit earnings growth for the other 496. So Brothers just told us the expectation in Q2 is 5.4% for the 496. So you tell me how we get that ratcheted up, okay, to something that's close to 10%. Overall, the estimated earnings growth rate for the entire S&P 500 for Q4 is 17.1%. Okay, that's year over year. NVIDIA, Amazon, Meta, and Google combined are projected to report earnings growth of 28.4% for Q4. The estimated earnings growth rate for the other 496 companies for the S&P 500 is 15.7 in Q4.
Yeah, you better hope that those other basically 490 or odd companies come in a meaningful way, close to or exceeding those expectations, because that's what's going to be required, I think, for this market to continue to have legs. I'll say this, given some of the economic data that I've seen, again, given my sense of what's going to happen to the unemployment rate and other things, I just don't see this happening. And you mentioned it earlier, and Doug Cass has pointed this out. I think 85% of this recent move from October has been on, not all, 85% of which has been on multiple expansion. The other 15-ish has been on earnings and revenue growth. Now, at a certain point, you have to flip that around, but we're not even close to that.
Yeah, no doubt. All right, Guy, do we have a couple minutes for a few questions here?
I do.
Why wouldn't we do that?
Well, real throw, before we have a question, I mean, not only are you seeing sell-offs in these big flying techs, but as you pointed out a number of times, Eli Lilly and Novo Nordisk are trading like tech names. Today, they're trading like tech names the other way. So real quick, you look at this chart, and again, is this the beginning of something? Who's to say? But that uptrend line is still in place. But, a back and fill to the trend line is a pretty significant drop from where we currently are.
Yeah. So not only do you have maybe a sentiment, kind of pullback, just as we've talked about how similar the price action has been in Lilly and Novo Nordisk, there's also some fundamental news. We've been tracking this on Fast Money a little bit. So a lot of competition in these weight loss drugs. So today it's Roche. They have a pill. A lot of folks, hey, these two companies are working on pills too. You know what I mean? But they kind of own the market for injectables right here. So Novo in particular, sitting right on that uptrend, Guy, from December. You see where that 200-day moving average is. You see where the low from just May is. I mean, that would probably be the first stop. Maybe by then you see that 200-day moving average up near that May low, which might be a good support level. But again, we just talked about with Schwab, there's ever any real fundamental news where there's real competition here or there's scrutiny about the prices that these guys are charging. It is an election year. We know a lot of pharma companies generally get in the sights of kind of populist messages on the election trail. So again, watch these levels. I think they're important because there is no valuation support here, guys.
From Chris L. Dan, with all the excitement around small caps and rate cuts recently, if the economy takes a turn south, will a couple of rate cuts even matter to these IWM stocks? And I think we addressed it. I know you have views on this. I'll take a shot. I think the answer is no. I mean, I don't think a couple rate cuts, 3, 4, 5 rate cuts even, are going to stem the tide for what I think is going on. Because for so many, first of all, a lion's share of these companies they have negative earnings, right? They don't make any money. So number one. Number two, most of them, if not all of them, are obviously very economically sensitive. And if the economy is slowing down, as I think that it is, they're not going to be basically insulated from that. So I think this move, which I guess makes sense in the context of what we're seeing, is going to be pretty short-lived, in my opinion.
Yeah, so interesting pickle here for some of these small cap companies because, again, like you said, very economically sensitive. We've been talking about the long and variable lags of monetary policy, right? So it didn't really start to kick in as they were raising rates all through 2022. We had the regional banking disaster, right, in March of 2023. That was part of the long and variable lags. Now, the flip side of this is that if you expect companies to be able to access capital so much easier and the like, and, lower rates make the interest expense lower and all that sort of stuff, great. But, 2/3 of the employment in this country, as you mentioned before, come from small and medium-sized, firms. So if they start laying off because the economy slows, doesn't that just create a sort of a cycle? Because if unemployment starts to tick up, then you're going to have less consumer demand. So to me, again, I would expect a retracement if the market or the economy starts to slow a little bit. And the economy slowing is the reason why the Fed would start to lower interest rates. So it is about as clear as mud, guys.
Well, we'll see how that plays out, but I think my stance. AM McLovin, we addressed this, but I want to give him his love.
McLovin.
Thoughts on the gap down in NVIDIA and or the triple Qs? I mean, I'll say this once again. If we pull up an NVIDIA chart, Jacob and Amanda can do it. You can look at March 8th. You can circle that engulfing pattern from March 8th. You'll see exactly what I'm talking about. And if you sort of, I guess if you can sort of zoom into that, it becomes much clearer in terms of the engulfing pattern. But you saw that. So go back to March 8th. You see what I'm looking at. By the way, at the time, that was an all-time high in NVIDIA. Traded lower on the day, engulfing pattern. We talked about it. Traded sideways for a couple of weeks and fell out of bed in the middle of April. I think peak to trough, we're talking about a 24% move. That worked itself off. We obviously saw what happened over the last couple months. June 20th, you had the same exact pattern that you saw on March 8th. You've traded sideways, and now you're starting to see the ramifications of that. There's a gap in the downside, probably comes in somewhere around $105 or so. And I think that's probably where we're headed, Dan.
Yeah, so kind of fascinating in a way when you think about from the April lows to those March 8th highs, or June 20th highs, sorry. You had price appreciation of over 80%. So this became at those highs a $3.3 trillion market cap company. So how much of this excitement or the guide that we're going to get is pulled forward in this? And that's what's different, I think, between June 20th and March 8th.
100%.
Okay. So now you have this kind of big gap lower on fundamental news. And so where is, I don't know, are we going to go fill in those gaps? You and I talked about that the other day from the earnings period that we had, back in May. So again, this is a tough one. If you think that 20% decline from the March 8th highs, you're likely to see something similar, then you're probably going to want to wait and see if it's kind of testing those gaps from May. And by then, maybe you see the 200-day moving average up near there, and maybe that's a good buy point, guy.
We're going to find out. I mean, I think we're pretty clear on where we stand.
Well, one thing I want to just hit really quickly. So in this last quarter that they just reported, the company had really easy comps. Okay. And that's why you had this huge, kind of year over year increase. The comps get much harder, okay, over the next few quarters. So that's on a year over year standpoint. And then on a period over period. So last year, Q1 guy, they grew earnings 24%, Q2 148%, Q3 49%, Q4 28%. They just grew in April 1st or April Q1 19%. Next quarter, period over period, expected 4, then 7, then 9. Okay, so you're seeing, at least in the estimates, a decel. And if their companies, their biggest customers, okay, signal that when they report over the next 2 weeks, this stock has lower lows in it.
Listen,
I know. I'm just saying, listen, people give us crap all the time. I don't care about the kind of the peanut gallery in a way. We're trying to point this stuff out. We're trying to point out how kind of big money managers think about this sort of stuff. And those are sort of the data that they're looking at. And they think about whisper numbers, and they think about past performance, and they think about valuation levels, and they put it all together. It's like a big mosaic. Okay. So to me, I think we've kind of navigated some of this stuff well of late. Yeah, I miss the price performance, but I got to tell you, in 25 years or 27 years, I've never seen this sort of action around a mega trend, even in the internet bubble, because it wasn't anything to this sort of scale.
Yeah, I mean, listen, again, I'll say this. My concern has been unfounded, but my overarching concern is, and I'll say this again, that there's a chance that more people get smoked in these types of names than actually make money.
In crypto. I mean, we've seen it in crypto 5 or 6 times.
And that's the problem. So, I'll continue to sort of point out the pitfalls, and I'll let other people pull out the pom-poms, and they've been right to do so. But man, when you see the turn, it comes seemingly out of nowhere. And then, again, out of nowhere, comments made in a Bloomberg interview a couple of weeks ago.
Yeah.
That's how these things typically start. Last question. If you have some time for questions today, which we obviously do, I would like to ask if there are any books on trading technical analysis that you would recommend. I know you're good at this.
Okay, there's a great book, and I got to get the name. It was one of the first books that I read. It was by Stan Weinstein, and I think it was Profiting in Bull and Bear Markets. So yeah, that's what it's called. Secrets of Profiting in Bull and Bear Markets. A lot of technical stuff in there, and that goes back, I think he wrote that like 30 years ago, but the guy I worked for when I started in the business in 1997, he gave me a copy of that. I love that book. I've read it a couple times. So check that one out.
There's a question about lumber, and the last I looked, I mean, lumber's had a huge move lower since March. I think if you look at the contract, and I don't know if Amanda can pull this up or not, it's going from about 615.5 down to about 480. I think, again, slow down. I mean, this is you talk about economically sensitive commodities. Lumber is one of them. So, you're talking about something that was probably, again, north of $600 in March. You see where it's trading now. I think it speaks to the general weakness in the economy, and one of the reasons why a lot of people are calling for the Fed to not be so slow on the trigger and to lower rates. But, we've seen it before. If you're too soon, I mean, just as think when inflation is dead, that's when it comes raging back. So to answer the question, I do think this is speaking towards some economic malaise, Dan.
And I want to make one other point about that question about me offering up a book from 30 years ago. And so, it's interesting that some of these books, they're just timeless. You know what I mean? Because psychology around markets, it doesn't really change. It hasn't changed in hundreds of years or so. And there's a great book, if you just want to get behind that, okay, it's Reminiscence of a Stock Operator. That's also a book that I read early on. And this was a book that was written over 100 years ago. And when you read this book, if you didn't know it was read 100 years ago, and you replaced U.S. Steel or some of these, shipping companies or whatever the hell that were associated with the Industrial Revolution, their manias existed back then, and they're not too different than the manias that exist right now. And make no mistake about it, when we were just looking at the S&P 500 with a $52 trillion market cap, and we looked at the global MSCI at 77 trillion, you get a sense that manias happen here in markets. So some of these books I think are great to read.
Behavioral finance does not change. I mean, as much as people like to think we've evolved, those things remain the same. So that's it. Unless something bizarre happens tomorrow, we will not be doing market call. But I mean, stay tuned, because you just never know. If in fact that's the case, we'll be back Monday. But I want to thank everybody for joining us. Of course, the fact that we had Butters here on Wednesday was just fantastic.
Yeah, Butters, man. All right, everyone. Thanks for being with us. We appreciate it. Hopefully we don't see you tomorrow, but we might see you tomorrow. Let's see.